Now let's take a few business situations and see how they impact the balance sheet. Let's start with investing. So you just decided to start a new company and to invest $10,000 of your own money. You put that money on the company bank account, which automatically increases the cash account on the asset side of the balance sheet by $10,000. At the same time, the company now owes you $10,000. We therefore increase the capital stock category on the equity side by the same amount. You actually need $15,000 more to start your operations and ask the bank for a loan. The loan is granted and you get $15,000 more on your bank account. Again, this gets added to the cash category of the balance sheet, totaling now to $25,000. You now have a new debt of $15,000 and need to add it to the liabilities side. The loan you have contracted is to be repaid during the next 3 years. You therefore put 1/3 of that loan on the current portion of debt category. This is the portion that will be repaid in the first year, and the rest goes to the long-term debt category. That money is needed to start production. You therefore decide to use $8,000 of that money to buy a piece of machinery. You therefore pay those $8,000 and reduce the cash category by that amount. Here, you use it to buy an asset. You therefore impact only the asset side of things. The reduction in cash is here offset by an increase of the net fixed assets category. Your balance sheet is still in balance. Let's get now into production. Now that you have your piece of machinery, you need to buy raw material. You spend another $2,000 on raw material, which reduces further your cash. If you remember, you started with $25,000 and purchased equipment for $8,000, leaving you with $17,000. With that new spend, you're left with $15,000. Again, on the asset side of the balance sheet, you have now $2,000 worth of raw material. This raw material is in your inventory, which therefore calls for increasing the inventory category by $2,000. With the raw material and machine, you transform the material into a finished product, ready to be sold. This transformation will have no visual impact on the balance sheet, but in the details, the $2,000 of raw material will be replaced by $2,000 of finished goods. Let's get now into selling. So you're now ready to sell goods to customers. You sell them for $3,000. The customer requests to pay in 30 days and you accept the term. The $2,000 inventory is now sold to the customer and the inventory category therefore goes back to zero. The $3,000 are added to the accounts receivable category on the asset side. The net impact on the asset section is an increase in $1,000 since you have sold for $3,000 goods that you paid for $2,000. You have increased the value of your assets and therefore the value of your company. You can therefore increase retained earnings on the equity side of the balance sheet by $1,000. The balance sheet is again in balance. 30 days later, the customer pays the $3,000 bill. So you can take out $3,000 from the accounts receivable category and increase the cash category by the same amount. Let's get now into paying stuff. The end of the month is coming. Did I tell you that you have one employee? Well, you need to pay her or his salary of $1,500, which includes $300 of employee contribution, and to which we need to add another $500 of employer taxes. To do so, we take out $1,200 from the bank account to pay the salary and reduce the cash category by that amount. On the liabilities and equity side, we increase the accrued expenses category by the $300 of employee contribution as well as the $500 of additional taxes to keep that tax money separate until the payment is made to the authorities. The salary and taxes that you paid will then have to come off the retained earnings category. The balance sheet is again in balance.